Good afternoon, everyone. Welcome to Cryptocurrency Taxation 101, the third program in Cohen & Company's 2021 Virtual Summer CPE series. Thank you for joining us. Before we get started, we would like to review a few housekeeping items. My name is Jennifer Novotny, and I will be your technical host for today. If you have any questions or challenges throughout the webinar, please send a message using the chat feature in your WebEx window and send your message to the host only. This webinar is eligible for CPE. In order to earn CPE credit today, you will need to be on the webinar for at least 15 minutes, and you must answer 3 out of 4 polling questions during the webinar to receive full credit. The polling questions will appear on the right-hand side of your WebEx panel throughout the webinar. You will have approximately 2 minutes to select your answer once the poll is opened. Please note the polling questions will appear in the presentation slides for your reference. Please be sure to hit submit once you have answered the question. At the end of the program, a survey will automatically appear. So please take a moment to evaluate the session as your feedback is very important to us. Please submit questions through the chat feature in WebEx to all panelists. We will try to answer as many questions as possible. We will follow up directly regarding any questions we are unable to get to in the allotted time. We are recording today's session, and a recording along with a copy of the materials will be available on the Cohen & Company website later this week. Please note, CPE credit is not available for watching the replay. CPE will only be awarded for those attending the live presentation. CPE certificates will be sent next week to the email address you provided at the time of registration. And now I would like to turn it over to our presenters, Cynthia and Brandon, to get us started. Thanks.
Hello, everybody. My name is Cynthia Peterson. I'm a tax director with Cohen & Company. I'm very excited to be here and presenting with Brandon. My background in cryptocurrency started in 2016 when I got involved from a consulting side. So I provide consulting services to our investment clients who are involved in the digital asset space. And I want to introduce Brandon, who's going to take away for beginning half of the panel.
Thanks, Cynthia. So I'm Brandon Miller. I'm a senior manager in the tax group here at Cohen & Company. I've been with the firm for about 14 years now, and I work primarily on the compliance side in terms of taxation of cryptocurrencies, and I've worked with cryptocurrencies probably for about the same length of time as Cynthia has, and occasionally I will dabble in the consulting side as well. So with the introductions out of the way, let's get started with the presentation. So we've basically split the presentation into two parts. The first is the overview of cryptocurrency and blockchain, which I'll primarily be tackling. And then we also have a section on cryptocurrency taxation, which Cynthia will primarily be tackling. So first, the overview of cryptocurrencies. So of course, the first question on everyone's mind is going to be, what's a cryptocurrency? And the definition we have listed is a digital asset designed to work as a medium of exchange using cryptography to secure transactions, to control the creation of additional units, and to verify the transfer of assets. Now that's a mouthful, and I know that some people are probably already going, man, he's already reading definitions from a slideshow. This is going to be a killer. So what I want to do now is break down some key components of that definition. First, digital asset. So the digital asset isn't particularly unique in today's fast-paced e-commerce based marketplace. You know, people already use things like credit cards and electronic fund transfers to move money around. However, what makes cryptocurrency unique is that it is entirely digital, whereas the credit cards and bank transfers that you use from your conventional US dollars and other currencies still have some kind of physical manifestation elsewhere. So you can still exchange that digital stuff for US dollars at any point, whereas cryptocurrency is entirely digitized. And then medium of exchange. So medium of exchange has been the backbone of any economic system since the beginning of time, whether that's been simple trade and barter. I've got some wood, you have some meat, let's make a deal, all the way up to modern concepts such as currency. So cryptocurrency doesn't particularly revolutionize anything there. It's there to facilitate a more technologically advanced method of making those exchanges. And finally, cryptography. Cryptography is the backbone of any successful cryptocurrency because it is the process of constructing and analyzing protocols to prevent the public, third parties, in particular bad actors, from reading private messages. So cryptography is what's there to keep any given cryptocurrency secure. And then cryptocurrencies are decentralized. And in a nutshell, what that means is that there's no central authority or Federal Reserve Bank or some kind of big organization that has controls over the levers. It is basically entirely in controlled by the users, and each of the users basically form a consensus to make that currency go. And where this came from is back during the times of the financial crisis, as that started to escalate. Satoshi Nakamoto, I believe if I got that right, is the person that came out with the Bitcoin white paper in 2008. Now, no one really knows if that individual is a real person or a combination of people or what they are. It's probably some kind of pseudonym, but basically this came out with this idea of Bitcoin or a currency that was not controlled by government and couldn't be manipulated. And this was a popular idea right around the time of the financial crisis when formerly trusted institutions became known as too big to fail and got massive bailouts from the government, and it was just a time of turmoil. And cryptocurrency had been thought of prior to that point, but until Bitcoin came out, some key issues with it hadn't been resolved. Among those, how do we prevent people from spending the same currency twice? Up until the time of Bitcoin, existing cryptography and other computing technology just wasn't sophisticated enough to prevent that. But now with blockchain, key issues like that would prevent cryptocurrency from being trustworthy have been solved. And while Bitcoin is still definitely the preeminent cryptocurrency, there's now over 5,800 cryptocurrencies listed on CoinMarketCap, which is a aggregation site that can be used to observe the trading volume, current conversion rates, and other information on cryptocurrencies. So that moves us into what's a blockchain. So a blockchain is a digital ledger that records and validates thousands of transactions and records them in the form of blocks. So what gives economic value to cryptocurrencies? The most important factor is trust. And I'm going to link that to the next point on decentralized versus fiat currencies. So as I mentioned, decentralized has no central authority. Fiat has a central authority. And in many cases, our fiat currencies do not use any kind of, gold standard or any kind of traditional backing anymore. It's just built on the trust that fiat currency, whether it be the US dollar, the British pound, or some other country's currency, is going to be accepted as a good store of value. And so the developers of cryptocurrencies said, well, why can't we form our own consensus on this having economic value, since, well, we've now as nations perhaps decided that these fiat currencies have value. So why can't we do that separate from some kind of centralized body? So cryptocurrency gets its value from a consensus of people agreeing to accept that it has value. And then with cryptocurrency, often there's terminology that tends to be used interchangeably, and this will come up throughout the course of our presentation. And the first one of these points are the terms coin and token. Typically, a coin represents something that's intended to be used like a currency, some kind of like a Bitcoin that can be used in any kind of economic situation. And a token typically has a specific function. One common type is a utility token, which may be used to engage in a very specific type of transaction on a platform. An example might be a token that represents currency in some kind of online game, where that token is a store of value, but only for that particular online game. And then, so now we have Bitcoin versus altcoins. Essentially, when cryptocurrency started, there was Bitcoin and effectively only Bitcoin. And over time, other coins were developed, some of which are now perhaps major currencies in their own right, such as Ethereum and Litecoin. But Bitcoin still has the preeminent amount of market share. And the reason why Ethereum is starting to fight its way into that conversation is because Ethereum blockchain has some applications outside of cryptocurrency that are also projected to be very valuable, and I will touch on those a little bit later in the presentation. And then we have exchanges, and these are basically places where you can trade or transfer tokens and coins. And at the last check, there were over 300 active exchanges listed on CoinMarketCap, and not all exchanges offer access to all actively traded cryptocurrencies. There are some exchanges that actually require conversion from fiat currency to Bitcoin or Ethereum to even enter certain altcoins. And with exchanges, it's very important to do your research on the exchanges, because that word unregulated is very key with the exchanges. So you have to do your homework. Right now, it's not believed that there's sufficient technology out there to actually hack a blockchain, which is why cryptocurrencies themselves are so secure. However, if there are going to be attacks on a cryptocurrency, they're going to happen at the exchange point, because the exchanges as entry points are a little bit more vulnerable than or quite a bit more vulnerable than the blockchain itself, I should say. So, and there have been numerous reports of exchanges being hacked. So definitely do your research, make sure the exchange is trustworthy. Typically, retail investors prefer to stick with tried and true ones like Coinbase for that reason. And then we have a wallet. It's an application that allows cryptocurrency users to store and retrieve their assets. And the key concepts with wallets are hot versus cold storage and private versus public keys. Hot storage is essentially storage that's connected to the internet. That could be directly on an exchange. So an exchange could provide a wallet place for you to actually transact on the exchange. So a hot wallet would be very popular with someone who's doing a lot of high frequency trading. Now, if you're just holding cryptocurrency for appreciation, definitely cold storage is preferred, because that's not connected to the internet. And we've actually heard of people that basically have whether it be external hard drives or whole computers that basically exist for them just for the purpose of having a cold storage wallet, and they rarely, if ever, connect into the internet. Because, of course, the downside to a hot storage wallet is that it is vulnerable to hack attacks because it is connected to the internet. And of course, as with exchanges, some hot storage wallets are going to be more secure than others depending on who the vendor is and other factors. And then perhaps one of the most important points to remember is the private versus public keys. So your public key basically exists so that other people on a blockchain can send cryptocurrency to you, and you would have access to a public key to send cryptocurrency to another person on the blockchain. The private key is very important. Basically, only you know that, and that is your access code to your cryptocurrency. If you lose your private key, there's a very, very high probability that cryptocurrency is lost forever to you. So I would say that if you remember one thing from this presentation, if you have cryptocurrency in a wallet, do not lose your private key. And then custody considerations. The custody for cryptocurrency is still undergoing considerable overhauls. There are increasing numbers of financial institutions that are willing to take custody of cryptocurrencies on behalf of retail persons, but it's very much in development because cryptocurrency's regulatory environment is still very much under development. And I believe that will take us to our first polling question. What is the most recent tally of cryptocurrencies with a listing on CoinMarketCap? And I need to flip the slide here. And you still have a few minutes to answer, or a minute or so to answer for CPE credit. But to keep the presentation moving, I will say that the answer is over 5,000. So again, if you're seeking your CPE credit, you still have a little bit of time to answer. So how are transactions validated? Typically, cryptocurrencies use what's called a consensus protocol for that purpose. And that's a mechanism used to achieve agreement on a data value. And the terms proof of work and proof of stake are the two most common consensus protocols in cryptocurrency. There are others, but these two are the ones that are most important to discuss. And in addition to them being critical for validation, they also determine what rewards participants receive for participating. And rewards may include the collection of a transaction fee, newly created coins or tokens, or perhaps both. So proof of work is also referred to as mining, and that uses raw computing power to solve complex cryptographic problems. And typically speaking, proof of work cryptocurrencies, the more and more of these coins that get mined, the harder and harder it is to solve the next problem to unlock the next coin. And over time, this will take more and more computing power to do it. So computing capacity is the measure of influence. Proof of stake, which can be referred to as staking or minting. Those terms are somewhat interchangeable. They have slightly different meanings, but they're generally, I've seen them used interchangeably, where staking tends to represent people that have coins staked, but not necessarily actively engaged in validation, whereas minting definitely has a validation component. And proof of stake uses a consensus protocol that rotates randomly among users or nodes with staked cryptocurrency, and it works in proportion to the amount of cryptocurrency staked typically. So the more cryptocurrency you have staked, the more likely it is that you'll be selected to serve as the next validator and collect that reward. And typically, proof of stake does require some kind of minimum amount staked to participate. And the amount of staked cryptocurrency is the measure of influence based on that mechanism. So the advantage of proof of work is that it's less vulnerable to attacks and less prone to forking due to the intense amount of resources involved. Forking is when there's a change in the cryptocurrency that effectively requires a split in the blockchain. And generally speaking, when there's a fork, people will receive a second cryptocurrency that represents how the new blockchain is going to proceed following the fork, and then users of the cryptocurrency can generally opt to keep both cryptocurrencies and proceed with both blockchains, or sell off the one that they don't want to proceed with. And then the disadvantage to proof of work is that it consumes a tremendous amount of energy. And when I say tremendous, I mean tremendous. It's rumored that in some periods that cryptocurrency mining has consumed the same amount of electricity as some small countries. Proof of stake, the advantage is that lower resource requirements encourage participation and lead to less energy consumption. And the disadvantage is that it may be more prone to low-cost attacks on nodes. Typically in proof-of-work cryptocurrencies, because of the amount of computing power required, those users tend to be more sophisticated, and thus it would be much harder to attack them. Because one, they're sophisticated. Two, you would need quite a bit of computing power to overcome a node that's based on computing power. And then briefly, these were much more common a few years ago, but they're still worth discussing. ICOs and SAFs. They were tools that blockchain startups use to raise capital. And typically they involve on investors gambling on a cryptocurrency at some kind of discounted rate. So think of it a lot like a private equity investment, where you're going to take a gamble that some of these things are going to hit really big. And the capital is typically raised in Bitcoin or Ethereum. And SAFs tend to be organized as forward contracts, and they became the preferred method for ICOs soliciting U.S. investors because they were believed to be more SEC compliant. And many of the ICOs and SAFs from the initial wave are now coming to fruition. So many of these were issued in 17, 18, and 19 and had a lockup period of a few years to allow for capital to be raised and for the coins to have enough behind them to actually enter circulation. And some of these transactions are still happening, although decentralized finance has now expanded in ways that provide a greater diversity of blockchain investment opportunities. So now we're starting to see more people actively engaged in lending, borrowing, providing liquidity to various financing pools. So there's a whole lot coming on board with decentralized finance. And I mentioned previously when discussing Ethereum that the Ethereum blockchain had a lot of potential for other applications. One such application is smart contracts, where two parties will agree to use the blockchain to exchange considerations, and then that will serve as an agreement, and the contract can be activated strictly in the digital environment. And these types of transactions are only going to become more prevalent as blockchain gains adoption. And lastly, regulatory considerations. So the CFTC and SEC had a little bit of a turf war early on, but that has died down somewhat. In general, it's been widely accepted recently, pending further guidance, that cryptocurrencies themselves are likely to be looked at more like commodities, and the CFTC would look at those, and things like ICOs or anything else that might become a security would be looked at by the SEC. Currently, many of the currently regulated investment company management is looking to launch ETFs based on cryptocurrencies such as Bitcoin, and the SEC is currently resisting the idea of ETFs, but that's going to become probably the preeminent battle with the SEC over the next year. And then, of course, we have the issue of unregulated exchanges, where unfortunately, until perhaps some more regulation comes down on the cryptocurrency exchanges themselves, you will still occasionally have issues where exchanges are either themselves not entirely honest, or they'll be subjected to hack attacks. And lastly, taxation is a huge regulatory consideration, and that's going to be where I turn it over to Cynthia. And that takes us to our second polling question. Which of the following statements regarding cryptocurrency validation rewards is untrue? All right, and those of you seeking CPE, still have a few, probably 45 seconds to answer, but the answer is D. And like I said, I will turn it over to Cynthia to cover the cryptocurrency taxation issues.
All right, thank you, Brandon. Now that we have a background on what is cryptocurrency and the blockchain, let's talk about taxation issues for investment purposes. I'm very excited about this. I know it's something that not a lot of people want to talk about. I feel like I'm a Debbie Downer whenever I go to events and have to tell people, you know, your transaction is probably taxable, but that is just kind of the nature of the beast. There is very limited guidance in this area regarding cryptocurrency from the IRS in general. They've only released crypto-specific guidance 4 times since 2014. And remember, Bitcoin came out in 2009, so it took 5 years to get our first piece of guidance, and that would be Notice 2014-21. It's an FAQ, or answers a bunch of questions. It's only about 3 pages long. If you haven't read it, highly recommend. Super easy read. It gives us the basis of our understanding of how all this will be taxed for all subsequent guidance. The main point is that cryptocurrency is considered property and not currency. As property, all general property rules apply. That includes whether you dispose of property, that's going to be a taxable event, reporting obligations, donations, everything stems from the fact that it's property. It's interesting to point out that the reason that the IRS looks at this as property currently is because they make a statement in Notice 2014-21 that no country utilizes this as legal tender. Now, that changed. In June of this year, El Salvador accepted Bitcoin as legal tender for their country. It's not replacing the US dollar as the official currency, but it's being utilized as a secondary currency that's available for the government payments. Does that going to change the IRS's position that it's property? Probably not. It just makes the statements that are in the current guidance sort of untrue, that no country uses as legal tender. So if additional countries do take that position, it might be something to monitor to see if this changes, but currently treated as property. 5 years later, 2019, we get our second piece of guidance. It's Revenue Rule 2019-24. That's specific to hard forks and airdrops and that taxation. It was a little confusing on the wording. So there was a follow-up guidance in 2021. That's the Chief Counsel Memorandum 2021-14020. That gives a specific real-world example of a hard fork, which was the Bitcoin to Bitcoin Cash hard fork that occurred in 2017. And it kind of goes over that. We're going to talk about that a little later. At the same time the revenue ruling came out, the IRS issued additional FAQs. Those were just to expand upon the original notice 2014-21. So it talks about for individuals or entities who are holding cryptocurrency as an investment asset. It gives a little bit more color as to what they believe should be applied there. The legal memorandum that came out in 2021, this came out a few months ago. I'm only touching on briefly here. We're not going to talk about it in the future. Essentially, it just reiterated the IRS's position that 1031 like-kind exchanges, which essentially going from one piece of property to another piece of property, would not be a taxable event, should not apply to specific cryptocurrency transactions. Specifically, they listed 3, Bitcoin to Ethereum, Bitcoin to Litecoin, Ethereum to Litecoin. Not going to be considered like-kind exchange treatment. That went away in general in 2017 with the Tax Cuts and Jobs Act. The 1031 like-kind exchange rules only apply from January 1st, 2018 forward to real property exchanges. So it's not a discussion that we really need to have. It's really more looking back in case anybody wanted to amend their returns if they feel like they took a position that wasn't correct. The statute of limitations window is closing. If you took a position that was like-kind exchange and want to talk to somebody about it, shoot us an email. We're happy to have that discussion. But again, statute of limitations window is shutting down. So not going to mention it again. This guidance, while does provide some information, again, those general property rules apply. It leaves a lot of gray area and a lot of interpretation for us on different rules and how they should apply. So we try to take as reasonable position as we can under the existing rules, knowing that they may not specifically apply to cryptocurrency currently. So how is cryptocurrency classified for U.S. tax purposes? We just talked about this, property, not currency. It's unclear if the IRS is going to take the position that it should be broken down into different types of property. As Brandon mentioned, there's the CFTC, the SEC to consider, and the IRS. They all kind of have to work together as to how these assets are going to be viewed. Some might have attributes of a security, others might have attributes of a commodity, or they might have attributes of some other financial instrument. There's no specific guidance in this area. And if the CFTC or SEC make decisions, that's not necessarily binding on the IRS. Do we think the IRS would probably go along with it? Yes, unless they found it to be completely unreasonable, which hasn't been the case so far. But absent that specific allocation of whether security, commodity, whatever, we have to take a reasonable position. So generally, as Brandon pointed out, we do view these as commodities, and then the general rules under commodities should apply to your cryptocurrency transactions. What does that really mean? There's questions around lending. There is no specific code section on commodities lending. There is on securities lending, but we don't look at these as securities. So that's code section 1058. Does that really apply? There's a lot of questions there. For people who want to get in and out of position to recognize a loss, those are called the wash sale rules. Those apply specifically to securities. If we don't view these as securities, do the wash sale rules really apply? A lot of questions there. And again, other issues with investment partnerships, which we're going to talk about later. What is the tax character of cryptocurrency? Again, it depends on what you're doing. A lot of this is going to be heavily based on the facts and circumstances of what the individual is doing or entity is doing with the cryptocurrency. If the cryptocurrency is held for investment, we would look at this as a capital asset, meaning that the capital asset rules would apply. Your basis tracking, your holding period is going to determine whether it's long-term capital gain or short-term capital gain. Also something to consider, the current administration might be getting rid of capital gain rates. So keeping that in mind, a lot of these differentials might not matter in a few years if things go as planned from that perspective. But if you're holding it in a trader business, if you're treating it such as inventory, for example, if you are in a mining entity or you're providing staking and you're validating or minting, as Brandon pointed out, that could rise to the level of trader business, meaning that the receipt of new tokens could be ordinary income as opposed to capital. But if you hold it for investment after receiving that ordinary income, your subsequent sale could be capital. It just kind of depends on what you're doing. So looking at the facts and circumstances is really important. Again, as we discussed, there's uncertainty depending on the different aspects, wash sale, lending, lot relief. There are some questions on that as well. However, the FAQs did provide some explanation as to how the IRS will look at lot relief, meaning whether it be first in, first out, last in, first out, or specific ID. They kind of list out specifically how you need to handle whether you're relieving when you're exchanging in and out of coins to get the actual basis of whichever token you want to use. Now, the big question there that hasn't been answered is when you're dealing with multiple exchanges, are you able to use lot relief across the different exchanges, which normally you would not be able to do if you were in a regular brokerage account. So there's something to consider. There are questions there. Go to the next slide. Sorry, I lost my. Oh, this leads us into our third polling question. Which of the following classifications definitely does not apply to cryptocurrency and digital assets in the view of the IRS? I should say currently, because I just brought this up. And we're going to think about it. It's in that notice 2014-21. It carries forward to all subsequent guidance. Could it be currency, property, commodity, security? What do we think? I think Brandon just answered in the chat. And just to move things along, it's going to be, oops, I'm in the wrong button. I want you guys to see it highlight. Currency. So again, currently, IRS views this as property. General property transaction rules apply. It's not a currency. It's not a fiat being a government-backed currency. We don't look at it as currency. So you have to be mindful of that when you're entering into different transactions. You cannot say, oh, well, it's similar to a currency. I transferred, from Bitcoin to Litecoin, Bitcoin to Ethereum, Bitcoin to whatever. That's going to be a taxable event because it's property to property. You're not looking at it as a true currency. There are specific rules, again, talking about forks and airdrops. This is going to be that revenue ruling 2019-24, also the Chief Counsel Memorandum, which I have here, 2021-14020. A hard fork is when a cryptocurrency asset has a protocol change. It results in a permanent division of the blockchain. Brandon kind of pointed that out. And when that happens, generally speaking, the holder of the blockchain is going to receive a secondary token that goes with the new blockchain, with the new protocol, whatever that may be. One of the big ones would be Ethereum and Ethereum Classic. Another one would be Bitcoin, Bitcoin Cash. Bitcoin went through a ton of hard forks. Not all of those additional coins actually survive, Bitcoin, Bitcoin Gold, just to name a few. But there were people taking different positions when a fork occurred as to how that should be treated prior to this guidance coming out. So again, we had that 5-year window where the only guidance we had was notice 2014-21. So prior to 2019, between 2014 and 2019, you kind of had to take a reasonable position. Some people thought, well, maybe you split basis between the two coins, like think of it as like a stock split. Other people said, well, no, you receive a new asset, but the asset value is zero because how could it have any value if it's just a newly created token? Other people said, no, not taxable at all until disposition, not dealing with it at all. The IRS kind of balked at all that and said, look, you're receiving a new piece of property. If you have dominion and control over that new piece of property, then you have you have income pickup at that time. What does dominion and control mean? It's demonstrated when a taxpayer has ability to sell, exchange, or otherwise transfer or dispose of that new asset. So this makes a difference as to how you held your cryptocurrency. As Brandon pointed out, you can hold on exchange where your exchange is holding the private keys, or you can hold in your own wallet where you hold your private keys. So if you were holding on exchange, this goes back to that Chief Counsel Memorandum, which is great because it really does provide a real world example as to how this would be taxed. It goes back to 2017 again. If you were holding on an exchange, say you were holding on Coinbase, Coinbase did not support Bitcoin Cash at the time of the fork. So those individuals who did not hold their private key would not have had dominion and control because they would have no way to access that Bitcoin Cash because Coinbase wasn't supporting it. So they didn't have a taxable event upon the fork, but they did have a taxable event. Recognize that the fair market value of the coin they received, technically you use any reasonable method to determine the value. In this event, if you're holding on Coinbase, Coinbase gave it a value when it provided it to you. You have dominion control at the moment it hit your wallet. For those individuals that hold their tokens or coins in their own wallet and they hold their private keys, you're deemed to have dominion control at the time of the split. So you would have had income pickup at that time because you have the ability by holding your private key to pull that new coin off the chain. Now, whether you had the sophistication to do it is another question, but from the IRS's perspective, you had the ability, dominion control, it's over, you have taxable income. Again, as I stated, they figuring out that fair market value, how much income to pick up at the time of dominion control, whether it be a hard fork, which they're kind of slowing down. We're not seeing a ton of those. They still do occur. Airdrops are also more common where you just receive, it's more like a marketing tool. You'll receive a new token just for having a wallet or for entering into a certain transaction, you get an additional token. That's going to be based on any reasonable method. You can use CoinMarketCap, you can use exchanges. You just have to make sure you're documenting why you're picking up that amount of value. And this is going to have to be reported on your individual return. If you're an individual investor, if it's an entity, again, has to be a pass-through or corp, it has to be picked up on your return. So there is taxable income here. Disposition issues. This is a big thing. We're dealing with property, general property rules apply. If you sell your cryptocurrency, whether it be for fiat or another cryptocurrency, you're picking up income. That's going to be based on the fair market value of the property or fiat that you receive and your adjusted basis of the cryptocurrency that you're disposing of. So it could be a gain, could be a loss. Either way, anytime you're moving out of a position in cryptocurrency, you have a taxable event. Please do not forget that. If you give a gift to someone, say your niece's 10th birthday, and you want to give her Bitcoin as a present, you get her a wallet, you transfer it into her wallet, it's now hers. That's a taxable event to you if that Bitcoin has appreciated over the period of time from when you purchased it to when you gifted it. You could also have a gift tax return depending on the true value. There could be reporting obligations around this. There is in the FAQs, if you make a charitable contribution of cryptocurrency to a charity, a qualified charity, you don't have to pick up the appreciation. Think of it similar to like a stock. You wouldn't have to pick up that appreciation, but gifts to individuals or to anyone else, you would have to pick up that income. Payments for services, same. It doesn't make a difference. You're paying cryptocurrency. It's just like you're paying a piece of property. So you're making a payment to someone. Let's say you have an employee who wants to be paying Bitcoin as opposed to fiat. That actually is occurring with a lot of the younger investors. The entity, if they held that Bitcoin for a period of time, there could be appreciation or depreciation that needs to be recognized upon the transfer to the employee upon that payment. So just keep that in mind. And we're also going to talk about information reporting as well, but there's a lot of issues around paying for services in cryptocurrency that we want to talk about. So just keep that in the back of your mind. You're paying in property. It doesn't get you out of your reporting or withholding for taxes obligations. One of the questions that we had brought up again, it was because cryptocurrency is not specifically included in any type of property type like commodity security. The question is whether this is the type of asset that would cause an entity to be an investment partnership. An investment partnership is an entity where more than 80% of the gross asset value is in certain types of assets, generally stocks and securities. The term stock and securities is actually expanded. It includes cash, it includes derivatives, it includes a list of things in the code section, but it doesn't say cryptocurrency because cryptocurrency wasn't around when that code section was created. So you kind of have to take a reasonable approach. What would the intent of why the entity is holding this be something that should be included in these investment partnership rules? Generally, we take the position as yes, unless you're a trader business like a mining operation or a staking entity that is actively validating. If you're holding this going in and out of positions trading for appreciation in the market, you're probably going to be an investment partnership. So when you're an investment partnership, there's two aspects to that. If you have in-kind contributions, so let's say you have partners that they've had Bitcoin since 2009 and they don't want to have a gain recognition event. So they like, well, let me go ahead and contribute my property to the entity. Then I don't have a gain recognition event. Well, if it's an investment partnership, you could have a gain recognition event. It's called the diversification rules. So upon contribution of property to an investment partnership, if that partner achieves diversification of their portfolio, so they get the benefit of additional assets, then the IRS looks at that as really it's a sale. It's not a true contribution. It's not a tax-free contribution. So if you have one partner putting in fiat, another partner putting in Bitcoin, that can be an issue about treating that as a sale as opposed to a tax-free capital contribution. Additionally speaking, if someone does, let's say you have 4 partners, they all put in Bitcoin, but then the partnership itself disposes of that Bitcoin to enter into other transactions, that appreciation, that gain that's locked into that Bitcoin that was contributed is owned by that partner. So that gain will then be allocated back to that partner. So even when you have somebody coming into an investment partnership thinking that they're not going to have diversification, so they're not going to have a taxable event, if anything occurs within that entity that causes a disposition of what would otherwise be their gain, they're going to have a taxable event anyway. So just something also to consider. If you push property out in kind distributions of investment partnership, You have disguised sale rules. So let's say I put in Bitcoin into an entity. 2 years later, I pull out Ethereum. Let's just, for argument's sake, say I didn't have a diversification event originally. Within 2 years, it's automatically considered a disguised sale, and I'll have a gain recognition event. Really, the IRS looks at 7-year period, but the first 2 years is when it's automatically disguised sale. So keep that in mind. If you also have let's say a fund that has foreign investors and you're trading in cryptocurrencies, it's unclear if the trading safe harbor under Internal Revenue Code Section 864 applies. That code section essentially says that if you're trading in securities or commodities on an organized exchange, you won't be deemed to be in a U.S. trade or business, meaning that there won't be any effectively connected income withholding or a filing requirement required by your foreign investors if they're in a flow-through entity. We already don't believe these to be securities currently, right? So then we're looking at commodities. Well, are they on an organized exchange? That's not defined. What does that mean? Are these exchanges under for cryptocurrencies going to be considered organized exchange for the purposes of the safe harbor? From our perspective, we believe that most exchanges should fall within this 864 safe harbor. Again, it is very facts and circumstances heavy, so you do need to be looking at that. Information reporting, I told you we were going to get back to this. If you are paying someone for services in cryptocurrency, you still have to report. It doesn't make a difference that's cryptocurrency. It's just a payment in property. So it could be a 1099 reporting. Again, remember 1099 branched off from miscellaneous for services. Now there's 1099 NEC for services. That was a form from the 80s. They just brought it back. Love the IRS. The secondary, if it's an employee, there's the W-2. Remember, you're paying someone W-2, there's payroll taxes withholding there. So you're going to have FICA, FUTA, other state income taxes. That's going to have to be paid in fiat. So take that into consideration when you're paying someone in crypto. It's not just going to be that crypto. You are still going to have fiat available for your federal and state income tax withholding. Back-end CRS, these are foreign financial assets of a U.S. specified person. It's unclear whether cryptocurrency falls within the definition of FACA reporting. However, from a protective standpoint, failure to file these foreign forms can be devastating for certain people. The penalties are very high, so it's always better to take more of a protective stance when you're doing these. We don't have any specific guidance in this area, but from our perspective, we would look at it as do a protective filing. FBAR, which is different, they're under the Financial Crimes Unit, FinCEN. Originally, they had made a statement, I believe it was in 2018, they had made a statement saying these are not reportable for FBAR purposes, but it was just a statement. It wasn't in writing anywhere. 2020, they came out with, I think it's Notice 2020-2. I have it written down here somewhere. Yes, Notice 2020-2, which essentially states that under the regulations, virtual currency is not the type of account that would be a reportable transaction or reportable account under FBAR, but they do intend to alter those regulations to include virtual currency, any virtual currency account. So currently, again, depending on if there are other assets held in a specific account, may not be reportable on the FBAR. If you want to take the protective stance and file the FBAR anyway, just to prevent any potential penalties, we are happy to do that. We generally have been doing that for our clients in the past, so we just move forward. It's not a difficult form to use. So again, kind of wrapping up on the information reporting, there's no specific guidance on how exchanges or other individuals should report to you, but you as an individual, as a U.S. person, you have reporting obligations because you're transacting in property. So it doesn't, just because it's cryptocurrency, just because it's a gray area, it doesn't get you out of these general information reporting requirements. But that doesn't mean you're going to get a 1099-B from Coinbase or from a Kraken or whatever the exchange you're going under. Also, the IRS is really ramping up enforcement, so this is your compliance risk. The 1040 has a question on it currently. Now, it used to be on the schedule, now it's on the front page. For 2020, the question specifically was, at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? This is kind of a confusing question. It seems to indicate that even if you bought cryptocurrency, you should be checking yes. They updated the instructions, specifically IRS updated the instructions saying, well, no, that wasn't the intent, because if you just purchase cryptocurrency, there's nothing to report. There's not going to be anything on your schedules because there's no taxable transaction. You just purchased a piece of property. It's really more, again, on that disposition. If you went in and out of a position, you paid somebody, you did something else that disposed of it, then you're going to have that checkbox yes. So for 2021, which will be reporting occurring in 2022, they updated that question to take out the acquire financial interest and just left it at dispose of financial interest. So that is a good change. But what's important to know is the steps that the IRS is taking with virtual currency or digital currencies is exactly the same steps that they took with reporting foreign financial assets. They started out with a question on the 1040 before we got the FBAR. And that opens you up to criminal liability if you intentionally mislead the IRS by checking no when you should have checked yes. So for anyone out there who's thinking, well, this is anonymous, I don't really have to provide this information, I can say, no, I'll be all right. Slow your roll. It's criminal liability for checking no, and you should have checked yes. The IRS is really ramping up enforcement. They've been John Doe summons to different exchanges. Kraken has gotten one, Poloniex has gotten one, Coinbase has gotten one. So if you think in any way you're anonymous, you're not. I'm really sorry to tell you, it's not anonymous. They will find you. They have a whole team around this. So be prepared to provide the proper information, keeping good records. It's all very, very important. This is the fun part. I know we're running out of time. I'm sorry. Emerging trends. Okay, so we had all this information going on previously, but every year something new comes out. This asset class is evolving. The transactions are becoming more complex. We have DeFi. DeFi is amazing. You're entering into lending transactions without having to utilize a bank. You can be a market maker. You can provide liquidity. You can stake. I mean, anything. And it's all in these apps that you have on your phone. You can create your own app. You can create your own stable coin. It's very easy. Easy to get scammed. Chill out. It's all right. But it's also very exciting. So there's a lot of questions around how this would be treated. A lot of practitioners say if you're in the DeFi space at all, then you're probably entered into a trader business. Just because as a market maker or liquidity provider, you're probably right into the level of trader business. Our firm, we take more of a facts and circumstances position. We want to see what's your level of activity, what are you doing, to figure out whether we still believe you're more passive, which would be if you have foreign investors, FDAP, which is just a withholding requirement, or if you rise to the level of that trader business, which again, if you have foreign investors, could be effectively connected income causing a filing requirement. So you do have to be kind of careful. The emergence of NFTs, they've been around for a little over a year, non-fungible tokens. These are interesting because they're really like a authenticator certificate of a piece of art or some other collectible, which means they have their own tax rates. Not all NFTs are going to be collectibles, but a lot of them are. So just like, for instance, it could be, you have a Monet painting and you own this little sliver, that's your NFT. I am authenticating owner of this little piece of this tangible asset somewhere. People are doing NFTs on periods of time, on basketball moves, on baseball cards. NFTs are great. They're kind of all over the place. Some of them are probably overvalued. Yes, like Charlie, you bit my finger. That's an NFT now. I think that went for like upwards of 70,000, something like that. So there's just a lot of emerging space here. There's a lot of tax issues that are going to be around these new asset classes as everything keeps going. We don't know where we're going to be in a year. And we don't know if the guidance that we have now is going to change. You can rely on certain pieces of guidance, the revenue ruling and the notice, those are published in the Internal Revenue Bulletin. So those are authoritative guidance. The FAQs, they're not really authoritative. Technically, you can't rely on them, but they do give you an understanding of where the IRS is going or how the IRS is thinking. So you shouldn't ignore them, but just be aware that the IRS can change their mind at the drop of a hat. Congress is also looking at this. There were 3 hearings today around different types of cryptocurrency, whether one was ransomware, one was whether there should be a centralized bank security, or not security, cryptocurrency in the US, the risks around that. The other one was what is cryptocurrency for the housing and urban units. So the government's looking at it, they're thinking about it. There's actually the Token Taxonomy Act of 2021. That's a piece of legislation that keeps getting reintroduced, but it hasn't been voted on yet, but it is, again, the regulators are here, they're thinking about this. They're never going to be able to keep up with what's really going on in the space, like the emerging trends. But over time, we will get more guidance and things will become more clear. So just keep thinking about it. Keep your head in the space. It's a very exciting time to be involved. And this is going to take us to our last polling question. Sorry, I had to speak a little fast there, but which of the following with respect to cryptocurrency taxation is the most accurate? A DeFi platform activity has little chance of being classified as trader business. I think we mentioned something around that. The addition of a cryptocurrency specific question to the 1040 increases the risks to taxpayers who do not report cryptocurrency taxation or transactions properly. Well, winky winky. A coin received in a hard fork for which a taxpayer does not have dominion control will be taxed immediately anyway, and none of these statements are true. I'm hoping if you guys were listening and you learned something and you enjoyed it, that you will get this answer right. So I'll give you a few seconds to do that and see. Jennifer, do we have any questions?
We don't have any questions in the queue yet. So if anybody has anything and you want to type something into the queue, we've still got a few minutes.
Please ask us. We're ready for anything, unless you thought we were just super amazing.
Great. Well, it looks like we're almost everybody has finished their polling. So.
All right, there we go. So yes, the application of that question to the 1040 is an increased risk. Remember, don't feel like you're anonymous. You're not. Monero might be, it's a privacy coin, is truly anonymous, but let's be honest, not everybody's holding only Monero. So answer your questions properly. And I think that's it for me. Brandon, is there anything you wanted to add?
Yeah, real quick with respect to this 1040 issue, this was something that Cynthia and I batted around internally. I know that a lot of retail investors have holdings in things like the Grayscale Bitcoin Trust. In general, we've generally recommended that if you're holding cryptocurrency through a vehicle like that and you have sales, that you also answer the 1040 question yes, because having a share of a grantor trust is like having a piece of that underlying asset. So you do have some kind of cryptocurrency holding in that context. So in general, if you're dealing with cryptocurrency, and if it's through a vehicle like that, you should probably answer the question yes.
And it looks like we did receive a question from one of the participants, specifically to the question is, would you still be considered a trade or business if you're an individual participating in the DeFi lending space? Again, based on facts and circumstances. Lending in general in cryptocurrency, there's no specific guidance saying that it's allowed. Technically, the IRS could come back and say, really, it was a sale buyback, which is all going to be taxable events all day. If you look at 1058, which is securities lending, and it should technically, we believe that case law before we got to 1058 should apply to allow lending in cryptocurrency. If you're entering into so many lending transactions that you could rise the level of trade or business, that's again facts and circumstances. So not every individual in the lending game is going to be trade or business, but that's not saying that everybody's not. It's really just on your facts and circumstances. Second question, when you earn native protocol tokens for providing liquidity, is it reported income at the time of you earning it or at the time you harvest it from the smart contract? Again, it's going to be on Dominion control. If you have the ability to transfer, dispose, or in any way interact with that token that you receive, then that's at the time it's going to be a taxable event. And remember, it's going to be based on the fair market value, any reasonable method to determine that fair market value, so long as you can explain what your reasonable method was to the IRS. So it's not necessarily when you harvest it. If you have a right to it before you harvest it, you have taxable income before you actually receive it. Oh my goodness, all these coming in now.
Yeah.
We got another one.
Brandon, do you want to?
Yeah, would interest received on a wallet balance paid in a cryptocurrency, would it be taxed as a capital gain or as interest? We believe that in that context, if you get a payment in a cryptocurrency that is in substance like interest, we would probably say that that would be ordinary income, but then you would hold that cryptocurrency, and unless it goes into some kind of inventory bucket, which is not likely for somebody that's an individual holding cryptocurrency, it would be a capital asset when it's sold. So if you collect some kind of interest payment that looks like interest, it's probably going to be ordinary income when you get it. And then when you go to sell the cryptocurrency you received as that interest payment, it would be a capital gain that time.
Right, and your basis in that asset would be the amount that you picked up as ordinary income. So then you'd only have capital gain on the appreciation from the fair market value when you receive it to when you sold it.
Great. And I think there was one other, I don't know, Cynthia, if you saw it. Should wash sale adjustments be taken into account since we are looking at crypto as a commodity and not a security?
This is open to interpretation. Generally speaking, we don't view these as securities, so we wouldn't apply the wash sale rules at this time. That's not to say that it wouldn't change in the future. Again, if the IRS does decide to allocate it, or I should say bifurcate away from property and go into security versus commodity. But as of right now, Brandon, let me know if you think any differently, but we don't look at the wash sale rules as applying currently in this space.
Yeah, I definitely agree with that. And overall, what we're hoping for in the future is that this asset class gets its own comprehensive look in the tax code, so that many of these gray areas are formally answered. Because even solving some of the questions like what property type is, it may not answer every question that's out there. For anyone who's familiar in the investment space, there was these kinds of issues came up with things like regulated futures contracts until the IRS put a provision in 1256 specifically for that asset class. So hopefully some kind of specific solution is worked out for cryptocurrency, because it doesn't fit neatly into any of the existing types of property. So we know it's property. From there, we're still guessing. We're hoping perhaps that it gets some kind of unique determination, and then it'll have all its own tax classifications, and it'll be much easier to tax plan and assist our clients.
Great, thank you. Well, we are now just past 1 o'clock. So I want to thank everyone for joining us today, and I want to give a special shout out to our presenters, Cynthia and Brandon. We hope you were able to gain some valuable insights from their presentation, and we hope to see you next week for the fourth and final program in the series, Manage and Defend Against Cybersecurity Risks, next Tuesday, August 3rd at 12 noon. And again, thank you, everyone.
Thank you, everybody.
Thank you.